You get a letter from the IRS. It's a situation that can make anyone's stomach just drop, right?
Oh, absolutely. Nobody likes seeing that envelope.
But imagine it's not for last year's taxes or even, the year before. It's asking about a tax return you filed, maybe didn't file from many, many years ago.
Yeah, way back.
Your immediate thought is probably, hold on, can they even do that? Isn't there like a time limit for the IRS to come after me?
Because the first question everyone asks.
Well, the answer, like so much of the U.S. tax code, seems to be, yes, there are limits, but they are far more flexible and frankly more complicated than most people realize.
That's absolutely right. The common understanding, that maybe it's just 3 years or something, that's often incomplete. Your actions, the type of income you have, whether you filed or didn't.
Right.
And even specific forms, particularly around foreign assets, can dramatically shift those timelines or sometimes completely remove them.
And that's exactly what we're diving deep into today. We've gathered a stack of sources, articles, research, our notes, basically trying to unravel the mysteries of the U.S. Internal Revenue Service's statute of limitations.
Mm-hmm.
Our mission, well, it's pretty clear. Cut through the noise, find the core rules, really dissect the crucial exceptions, and give you a clear picture of just how far back the IRS can genuinely reach, both for auditing your past returns and for collecting taxes you might owe.
A big task.
It is. So prepare yourself, because we're going to uncover some facts about these timelines that might genuinely surprise you.
And it's such a critical area because understanding these limits, and maybe even more importantly, the factors that extend them, well, that's key to managing your potential exposure and maybe getting some peace of mind.
Peace of mind and the IRS, not always in the same sentence. Okay, let's unpack this complex topic. Let's start right at the beginning. What exactly is a statute of limitations when we're talking about the IRS and your taxes?
Okay, so at its heart, a statute of limitations is basically a legal deadline. It's a law that sets a specific time limit for legal action to be taken.
Like a timer.
Exactly, a timer set by law. Our sources point to the Merriam-Webster definition, calling it a statute assigning a certain time after which rights cannot be enforced by legal action or offenses cannot be punished.
Okay.
So for the IRS, it just means there's a deadline for them to say, hey, you owe more tax, or to actually collect tax that's already been determined you owe. Once that clock runs out, their power to act, it generally expires.
So it puts a boundary on the government. They can't just come back forever on any old tax issue. And you mentioned there isn't just one, but two main types of these statutes that taxpayers really need to understand.
Precisely. Yeah. They govern different parts of the process. First, there's what's called the Assessment Statute of Limitations. You'll often hear it called the ASD.
ASU. Okay.
This is the time limit the IRS has to audit your tax return.
Mm-hmm.
And if they find errors or you miss something, to assess any additional tax, penalties, and interest they think are due.
So assessment is like the initial investigation and figuring out the official amount owed.
Exactly. Think of it as the window for the examination for determining if there's a tax liability and how much it is.
All right, ASED for audit and assessment. What's the second type?
The second one is the Collection Statute Expiration Date, or CSED.
CSED.
This deadline kicks in after a tax liability has been formally assessed, so they've already decided you owe something. The CSED dictates how long the IRS has the legal authority to actually collect that debt.
Ah, so this is about getting the money.
Right. This covers enforced collections, things like seizing assets, hitting your bank accounts with a levy, or garnishing your wages, the heavy-duty stuff.
Got it. Okay, two separate clocks. ASD for figuring out if you owe more, and CSE for making you pay it once it's decided you do. Why is knowing this difference so important for, the average taxpayer?
Well, ultimately, once these statutory periods expire, the IRS generally loses its legal right to assess more tax or collect the existing tax for that specific year.
Which sounds great. Finality.
It can provide significant relief, absolutely. Finality. But, and this is the critical part, the part we'll spend most of our time on today, it's understanding the many ways these dates can be pushed back, or how the statutes might not even start running at all.
Ah, the exceptions.
Exactly. Relying just on the basic time limits without knowing those exceptions, that's a really common and sometimes very costly mistake.
Okay, let's establish those basic time limits then. These are the numbers most people might have heard tossed around. 3 years to audit, 10 years to collect. Let's start with the standard audit period, the ASEV. What's the general rule there?
For the vast majority of tax returns that get filed, the standard assessment statute of limitations is 3 years.
3 years.
Which means the IRS generally has a 3-year window from the time you file your return to kick off an audit and assess any additional tax.
And when does that 3-year clock actually start ticking? Is it like January 1st?
Right.
Or when I actually mailed a return or hit send?
That's a key detail, and it trips people up sometimes. The 3-year period typically begins on the date your tax return was actually filed, or the original due date of the return.
Okay.
Whichever date is later.
Whichever is later. So let's say I'm super organized. I file my 2023 return way early, like in February 2024. The normal due date is April 15th, 2024. The 3 years don't start counting down from February.
Correct. Filing early doesn't shorten the statute for you. For a timely filed return, whether you filed it on January 30th or April 15th, that 3-year clock starts from the original due date, usually April 15th.
Or the next business day if the 15th is a weekend or holiday.
Right, exactly.
Okay. And what if I file late? Let's say I missed the deadline, didn't get an extension.
If you file late without a valid extension, then the 3-year clock starts ticking from the actual date you do file that late return.
Ah, so filing late actually keeps that year open for audit longer. It pushes the start date back.
It does. It delays the start of the statute running.
Okay, so for most routine returns filed on time, it's 3 years from the deadline. If filed late, 3 years from when you actually filed. After those 3 years pass, the chance of a random audit for that specific year goes way down.
Significantly.
But as you hinted, that's only if none of the exceptions apply.
Precisely. And those exceptions, well, they're really important. Now let's look at the other side. The standard collection period, the CSED. Once a tax has been assessed, how long do they usually have? Generally, the IRS has 10 years to pursue collection of that debt, the tax itself, plus any penalties and interest that have piled up.
10 years. And this 10-year clock starts from the date the tax is assessed, right? Not necessarily when the return was filed or the tax was originally due.
That is a really, really important distinction to understand. The 10-year collection period, the CSED, runs from the date of assessment.
Okay, so what counts as the assessment date?
Well, for tax you reported yourself on a return you filed on time, the assessment date is usually the same as the ASED start date, the later of the filing date or the due date.
Okay, simple enough there.
But it can be different. Let's say the IRS audits you and they propose you owe more tax. That extra amount isn't officially assessed until you either agree to it or they issue a formal notice of deficiency and you don't challenge it in tax court within 90 days.
Or if you do go to tax court after the court's decision is final.
Exactly. Or say you file an amended return that shows you owe more tax than you originally reported. That creates a new assessment date just for that additional amount.
Okay.
And another scenario, if you don't file and the IRS eventually files what's called a substitute for return, or SFR, on your behalf using information they have.
Like from my employer's W-2.
Right. That SFR process creates an assessment date, and that starts the 10-year collection clock ticking.
Okay, so the assessment date can vary, but once it's set, they generally have 10 years to collect. What kind of tools do they have during that decade?
Within that 10-year CSED window, the IRS can use various collection methods. They can file a notice of federal tax lien, which attaches to your property. They can issue levies on your bank accounts or other financial assets. They can garnish your wages or even your Social Security benefits in some cases.
And what happens if they just don't manage to collect it within those 10 years? Does the debt just vanish? Poof.
Well, under the law, specifically Internal Revenue Code Section 6502, if the IRS doesn't successfully collect the assessed tax within that 10-year statutory period, they generally lose the legal authority to use those enforced collection actions we just mentioned, the lands, the levies, the garnishments.
So the pressure comes off.
The enforced collection pressure does. This 10-year limit was actually a significant part of the IRS Reform and Restructuring Act back in 1998. It was designed to provide taxpayers with a definite end date for most collection efforts.
Okay, so their power to force collection expires. But is the actual debt itself wiped clean? Or is it just labeled uncollectible?
It's generally considered uncollectible by the IRS once the CSED expires. However, one of our sources brings up an interesting point, a potential consequence.
Wow.
Depending on your specific financial situation, the forgiveness of debt, even if it's just because the statute ran out, could potentially be treated as taxable income to you in the year the statute expires.
So you might stop worrying about the IRS collecting, but then you might get a 1099-C for cancellation of debt income.
It's a possibility in some circumstances. So while the collection actions stop, there might be a kind of trailing tax implication to be aware of. It's not always just gone completely.
Okay, so the standard playbook. 3 years audit assessment, 10 years collection. Sounds straightforward enough.
Seems simple on the surface.
Well, here's where it gets really interesting, maybe a little scary, because of those timelines. They are far from absolute. They can stretch out significantly or even, disappear entirely based on certain circumstances and, crucially, based on your actions.
This is the part that often catches people completely by surprise. Let's dive into these key exceptions and these things called tolling events that pause the clock.
Okay, where do we start?
Let's start with a fairly common exception that extends the audit period, significantly underreporting your income.
This is the rule about omitting income, right? If you leave too much off your return, the 3 years isn't enough for them.
It's not. If you omit an amount of gross income from your tax return, and that amount is more than 25% of the gross income you actually reported on the return,
More than 25%.
then the standard 3-year audit period automatically extends to 6 years.
6 years. So double the normal time. Can you give us an example to make that clearer? More than 25% of the reported gross income.
Sure. Let's say you file your return and you report $100,000 in gross income. Later, the IRS finds out you actually had an additional $30,000 in income that you didn't report. Well, $30,000 is 30% of the $100,000 you reported. Since 30% is more than 25%, boom! The audit window for that specific tax year extends from 3 years to 6 years, starting from when you filed or the due date, whichever was later.
Got it. So it's a purely mathematical test. It's based on the percentage of the omission compared to what you did show them. Now, does it matter why I forgot that $30,000? Like, what if it was an honest mistake or I really thought it wasn't taxable?
That's a really important point. According to the source material, this 6-year rule, the one based purely on the 25% omission threshold, it applies regardless of your intent.
Really? Even if it was accidental?
Yes. The longer statute is triggered simply by the fact of that substantial omission. It doesn't matter if it was an unintentional error, a misunderstanding of the law, or even if you had a good faith argument for why you didn't report it. Now, intent becomes absolutely critical if we start talking about potential fraud.
Which we'll get to.
Right. But for just triggering the 6-year window based on the 25% rule, intent doesn't matter. It's a bright line test based purely on the numbers.
That's a huge takeaway. A big enough mistake, even an honest one, doubles their audit time. Now, what if the reason my tax was too low wasn't because I omitted income, but because I claimed, say, way too many deductions or credits I wasn't really entitled to? Does that also trigger the 6-year rule?
Another critical nuance. The 6-year rule specifically applies to the omission of gross income.
Only income.
It does not apply if the underpayment of tax was caused solely by overstating deductions or credits. If you just inflated your expenses, the standard 3-year audit period would generally still apply.
Unless,
of course, other factors were involved, like, again, potential fraud in claiming those deductions.
Yes.
But the 25% rule itself is tied strictly to omitted income, not overstated deductions.
So leaving income off the top line is treated differently under this specific rule than puffing up expenses further down the form. And there was some back and forth on this legally, right? So something about cost basis.
Yes, you're thinking of the home concrete case. The Supreme Court initially ruled that overstating your cost basis in an asset like saying you paid more for stock than you really did, which reduces your taxable gain when you sell it, wasn't technically an omission of gross income.
They said it reduced the gain, not the gross amount received.
Exactly, a very technical distinction. And that ruling would have limited the IRS to the 3-year statute in those kinds of cases. But Congress didn't like that outcome.
So they stepped in.
They did, very quickly. Congress passed legislation to effectively overrule the home concrete decision. They made it clear that, yes, understating your income by overstating your basis is now considered an omission of gross income for the purpose of triggering that 6-year statute if it crosses the 25% threshold.
Wow. It really shows how specific the tax code gets and how Congress can react pretty fast when a court decision doesn't align with their view of the law.
Okay, so that's the 6-year rule for substantially underreporting income. What about, well, the most extreme taxpayer scenario, just not filing a return at all? Yes. The scenario described in one source is a particularly risky route, and for good reason. If you were legally required to file a tax return for a specific year, but you never file it,
Never send it in.
then there's no statute of limitations for the IRS. None. Not for auditing that year, not for assessing tax, not for collecting the tax you owe for that year.
No statute at all. Indefinite.
Indefinite. The audit and collection window for unfiled returns remains open forever.
So decades later, theoretically, they could discover you never filed for, say, 2005 and come after you for it today.
Theoretically, yes. The statute clock simply never starts running if the required return isn't in their hands. This is a huge reason why tax professionals almost always advise clients to file something, even if it's years late and they can't possibly pay the tax due right now.
Just get it filed to start the clock.
Exactly. Filing, even very late, at least gets that standard 3-year assessment clock, the ASC, started for most issues. Not filing leaves you perpetually exposed.
Now, what if the IRS figures out I didn't file, maybe from that W-2 info, and they prepare one of those substitute for returns, an SFR, on my behalf? Does that start any clocks?
That's a slightly tricky point based on the sources. When the IRS files an SFR, they can use it to assess the tax based on the information they have.
Okay.
And that assessment does start the 10-year collection clock, the CSED, for that specific liability. So they have 10 years to collect the tax shown on the SFR.
But what about the audit clock, the ASED?
That's the catch. The Audit Statute, the ASAD, does not start running just because the IRS filed an SFR. It only starts running when you, the taxpayer, file your own original return for that year.
Wow. So even if they file an SFR and start the collection clock, I'm still open to being audited on that year indefinitely until I file my own Form 1040.
And that appears to be the rule. It's a really powerful incentive for you to eventually file your own return, even if it's many years late, just to finally start that 3-year assessment clock and get some closure on the audit risk.
Okay. Indefinite risk for unfiled returns. What about situations where the IRS suspects more than just a mistake or non-filing? What about intentional wrongdoing or fraud?
Fraud is another major area where the standard statutes go out the window. If the IRS can successfully prove fraud, and we need to distinguish between civil and criminal fraud here, the consequences for the time limits are severe.
Let's start with civil fraud.
Okay. For civil fraud, if the IRS can prove it, there is generally no statute of limitations for them to audit your return and assess the additional tax, interest, and hefty fraud penalties. Just like with unfiled returns, the period for civil fraud is indefinite.
So if they can prove civil fraud related to, say, my 2010 return, they could come after me for that tax and penalty in 2030, 2040, whenever.
Yes, exactly. If they establish civil fraud, that tax year effectively remains open for assessment forever.
Okay. How is that different from criminal fraud?
Good question. Civil fraud is pursued by the IRS itself. The goal is primarily financial. Recover the unpaid taxes and impose significant monetary penalties, which can be up to 75% of the underpayment that's due to the fraud.
Ouch.
Criminal fraud, on the other hand, well, that's investigated by the IRS's Criminal Investigation Division, or CI, but it's actually prosecuted by the Department of Justice. It's treated as a serious crime, a felony. The goal there is punishment, potentially large fines and imprisonment, in addition to you still owing all the back taxes, civil penalties, and interest.
So, much more serious consequences with criminal fraud. Does criminal fraud also have an unlimited time limit for the government to bring charges?
No, and this is a really crucial distinction. While the civil assessment for fraud is unlimited in time, criminal tax fraud or tax evasion typically has a 6-year statute of limitations.
6 years for criminal charges.
Right. The government generally has 6 years to indict you for criminal tax offenses. That 6-year clock usually starts running when the crime was committed, like when the false return was filed or the act of evasion occurred. Sometimes it might start later if the fraud wasn't discovered immediately.
So the risk of actually going to jail for tax evasion generally expires after 6 years, but the IRS could still come after you for the money and civil fraud penalties indefinitely.
That's the gist of it, yes. The criminal prosecution window closes, but the civil liability window for fraud stays wide open.
Okay, how does the IRS actually define fraud? What do they need to show to prove it, either civilly or criminally?
The sources define fraud pretty consistently. It involves intentional wrongdoing. The key is having the specific purpose of evading a tax that you know or believe you owe. It usually involves some kind of deception, misrepresentation of important facts, or maybe deliberately staying silent when you have a duty to speak up.
And what's the burden of proof? Do I have to prove I didn't commit fraud?
No, absolutely not. The burden of proof is always on the government. But the level of proof differs. For civil fraud, the government has to prove it by clear and convincing evidence.
Clear and convincing. What does that mean, practically?
It's a higher standard than the usual preponderance of the evidence in civil cases. It means the evidence has to show that it's highly probable or reasonably certain that fraud occurred.
Okay. And for criminal fraud?
For criminal fraud, the standard is the highest one in our legal system. Proof beyond a reasonable doubt. That's a very heavy burden for the prosecution.
What kind of evidence are they looking for to meet those standards? What points towards fraud?
Well, the sources talk about 2 types of evidence: indicators of fraud and affirmative acts of fraud.
Indicators versus affirmative acts.
Right. Indicators are like red flags. They don't prove fraud on their own, but they strongly suggest deceit and usually trigger a deeper investigation. Think things like keeping two sets of books, making false entries or altering documents, dealing in large amounts of cash unexpectedly, spending way more money than your reported income supports, having big unexplained bank deposits.
Things that just look fishy.
Exactly. They raise suspicion. But to actually prove fraud, especially criminal fraud, they generally need more. They need affirmative acts.
Affirmative acts, like what?
These are specific deliberate actions taken to mislead or conceal. This is what really establishes the intent to deceive. Examples would be deliberately omitting specific chunks of income, especially if you reported similar types of income, actively concealing bank accounts, maybe offshore accounts or other assets, failing to deposit business receipts into business accounts to hide income, creating fictitious invoices or dependents, or actively covering up where your income came from.
So it's not just looking suspicious, it's taking concrete steps to cheat the system.
Precisely. An indicator makes them look harder. An affirmative act is often what seals the deal on proving fraudulent intent.
It sounds like there's supposed to be a significant difference legally anyway between making an honest mistake, even a big one, and taking actions the IRS would view as deliberate fraud.
Yes, and there's a very important legal line drawn here between tax avoidance and tax evasion.
Avoidance versus evasion.
Right. Tax avoidance is perfectly legal. It's using the tax laws to your advantage to minimize your tax liability. Taking legitimate deductions and credits, structuring transactions in a tax-efficient way, contributing to retirement accounts, that's all avoidance. There's no deception, no concealment. You're playing by the rules.
Okay, and evasion.
Tax evasion is illegal. It involves deliberately using deceit, concealment, misrepresentation, or other illegal means to escape paying taxes that you legally owe. It requires that affirmative act we just talked about, that intent to cheat.
That's a vital distinction for everyone to understand. Legal avoidance is smart planning. Illegal evasion is a crime with potentially indefinite civil consequences. Okay, so we have indefinite statutes for unfiled returns and for civil fraud. Now let's shift gears slightly to another area that seems to be a major focus for extended timelines. Anything involving foreign income or assets.
Absolutely. This is an area where the IRS has really ramped up enforcement, and the statute of limitations rules definitely reflect that heightened scrutiny.
So what's the basic rule if I simply forget to report some income I earned overseas?
There's a specific rule here. If you omit from your tax return an amount of gross income that comes from sources outside the United States, and that omitted amount is more than $5,000,
More than $5,000 of foreign income left off.
then the standard 3-year audit period is extended to 6 years.
So similar to the 25% rule for domestic income, but here the trigger is a flat $5,000 threshold specifically for foreign source income.
Exactly.
Yeah.
It doesn't matter what percentage it is of your total income. If you omit more than $5,000 derived from foreign sources, maybe interest from an overseas bank account, rent from a foreign property you own, dividends from foreign stock that kicks in the 6-year audit statute.
Now, what if I did report the existence of my foreign bank account? Like I filed the FBAR form, the report of foreign bank and financial accounts. Does properly filing the FBAR protect me from this 6-year rule if I still forgot to report the, say, $6,000 in interest it earned?
That's a great question. According to one source, this 6-year rule for omitting the foreign income applies even if you correctly filed the FBAR disclosing the account itself.
Wow.
The omission of the income earned from that account is what triggers the 6-year tax audit period for the income tax return. It's also worth noting, kind of relatedly, that the FBAR form itself also has a 6-year assessment period for potential penalties if you failed to file it or filed it incorrectly.
Yeah.
So those timelines often align.
Okay, so just reporting the account isn't enough. You have to be super careful to report every dollar, or rather every $5,000 plus hours of income it generates. And you mentioned other foreign-related forms. This is where the statute can get even longer, right? Potentially. Indefinite.
This is where things can get particularly harsh, yes.
Yeah.
Potentially leading to indefinite statutes, not just for the foreign issue, but for your entire tax return for that year. There are several specific information returns related to foreign financial activity that carry very, very serious consequences if you fail to file them when required.
Like which ones?
Okay, for example, if you receive a gift or an inheritance from a non-U.S. person and the total value is over $100,000 in a year, you're generally required to file Form 320. It's called the Annual Return to Report Transactions with Foreign Trusts and Receipt of Certain Foreign Gifts.
Form 3520 for large foreign gifts. What happens if I just don't file it? Maybe I didn't know I had to.
If you were required to file Form 3520 for a particular year, and you failed to do so, the assessment statute of limitations for that entire tax year related to the items required on that form never starts to run.
Never starts. Indefinite audit risk just for missing a form about receiving a gift? Not even income I earned myself.
That appears to be the rule. The filing requirement is strict, and the penalty for noncompliance regarding the statute is severe and indefinite audit window for issues related to that foreign gift or trust transaction.
Okay. What else?
Similarly, there's Form 8938, the Statement of Specified Foreign Financial Assets. This is required under FACSIA, the Foreign Account Tax Compliance Act. U.S. taxpayers who hold foreign financial assets above certain thresholds have to file this form with their tax return.
Form 8938 for reporting foreign assets over a certain value. And if I miss that one?
Same consequence, essentially. Failure to file a required Form 8938 also means the IRS's assessment clock never even starts to run for that tax year. Again, indefinite audit exposure for the entire return.
It really feels like the IRS is using these forms as major leverage to force transparency about any offshore wealth or activity.
That's absolutely the policy goal, yes. And perhaps the most striking example, the one with the most sweeping consequence, relates to Form 5471.
Form 5471, what's that for?
It's the information return of U.S. persons with respect to certain foreign corporations. Basically, if you're a U.S. person, citizen, resident, green card holder, and you have a certain level of ownership or control in a foreign corporation, you generally have to file Form 5471. It's a complicated form.
Okay. And the penalty for not filing it, let me guess.
You probably guessed right. If you fail to file a required Form 5471, it means your entire tax return for that year remains open for audit indefinitely.
The entire return, not just stuff related to the foreign corporation.
That's what the sources indicate. It's described as a sweeping override of the normal 3-year or even 6-year rules. Your whole 1040 for that year stays open forever for any issue, just because you miss filing that one form.
That is breathtakingly harsh.
It is. And on top of that indefinite statute for the whole return, there's often a separate monetary penalty, typically starting at $10,000 per form per year, just for the failure to file, even if no extra tax was ultimately due from the corporation's activities.
Wow. An indefinite audit statute for your entire personal tax return, plus a $10,000 penalty just for missing one foreign corporation reporting form. That definitely qualifies as one of those surprising facts you mentioned at the start. It really hammers home the IRS's intense focus on international tax compliance.
It's a very clear message from Congress and the IRS. Compliance with these specific foreign-related information reporting requirements is absolutely non-negotiable if you want the standard statutes of limitations to apply to your tax return. Fail to file these, and you could be looking over your shoulder forever.
Okay, that's sobering. We've covered situations that extend the audit statute, big income omissions, not filing at all, fraud, and these critical foreign reporting failures. Now, let's shift back and look at how the collection statute, that standard 10-year CSED, can be affected. You mentioned these delays, or tolling events, are often triggered by actions we take as taxpayers.
Exactly. Various actions you might take, often to try and resolve your tax debt, can essentially hit the pause button on that 10-year collection clock. When the action is over, the clock starts ticking again, but the pause time gets added to the end, extending the CSED beyond the original 10 years.
Okay, what are some common taxpayer actions that cause this pausing, this tolling effect?
A very common one is filing for bankruptcy. When you file a bankruptcy petition, an automatic stay immediately goes into effect.
Right, that stops creditors.
It stops most creditors, including the IRS, from taking collection actions against you while the bankruptcy case is ongoing. This automatic stay pauses the 10-year collection clock for any taxes that aren't discharged in the bankruptcy.
And what happens when the bankruptcy case ends?
Once the case is over, either the debts are discharged or the case is dismissed. The CSED clock starts running again, but the IRS gets bonus time. The clock is paused during the bankruptcy, plus they get an additional 6 months tacked onto the end of the remaining CSED period.
So bankruptcy definitely pauses the clock and adds extra time for the IRS to collect afterwards. What about trying to negotiate or settle the debt directly with the IRS?
Yes, those actions typically toll the statute as well. If you submit an offer in compromise, or OIC, that's a formal proposal to settle your tax debt for less than the full amount you owe.
Trying to make a deal.
Right. The 10-year collection statute is paused or tolled while the IRS is considering your OIC application. This pause continues during the entire time the offer is under review. Then for 30 days after they reject it, if they do, and also during the whole time, you might pursue an appeal of that rejection.
So the clock is stopped for potentially a long time during the OIC process.
It can be, yes. And then an extra 30 days gets added to the CSED after that whole process finally concludes, whether the OIC was accepted, rejected, or withdrawn.
Okay, what if I just asked for a payment plan, an installment agreement?
Requesting an installment agreement, which is a formal plan to pay off your tax debt over time through monthly payments, also pauses the 10-year collection clock. Specifically, it's told during the period your request is being reviewed by the IRS before they approve or deny it.
So just the review period for the installment agreement request pauses the clock?
Generally, yes, while the request is pending.
What if the IRS tries to take collection action, like a levy, and I decide to fight it through an appeal?
Good question. If you exercise your rights and request a collection due process, CDP appeal, which you can do after receiving certain IRS notices like a notice of intent to levy or a notice of federal tax lien filing, that action also pauses the 10-year collection statute while your appeal is pending with the IRS Appeals Office.
Okay.
Similarly, applying for a Taxpayer Assistance Order, TAO, from the Taxpayer Advocate Service, which is an independent organization within the IRS that helps taxpayers resolve problems, can sometimes pause the collection statute while they look into your case.
Are there personal circumstances, maybe outside of dealing directly with the IRS, that can pause the collection clock, like being out of the country?
Yes, that's another tolling event. If you are physically outside the United States for a continuous period of 6 months or more, the 10-year collection clock is paused during that time. It won't expire until at least 6 months after you return to the U.S.
That makes practical sense, I guess. It's harder for them to pursue collection actions when you're living abroad. Now, can a taxpayer ever just voluntarily agree to give the IRS more time to collect, like sign something?
Yes, you absolutely can. You can sign a voluntary waiver to extend the statute of limitations. While we often think of waivers in the context of extending the audit statute, which we'll talk more about, they can also be used to extend the collection statute, the CSED.
Why would the IRS ask for that?
The IRS sometimes requests these CSED waivers, particularly when you're setting up a longer-term installment agreement. They want to make sure they have enough time left on the clock to actually collect the full amount under the payment plan you've agreed to, which might stretch out for several years.
So they might say, we'll give you this payment plan, but you need to agree to give us more time to collect just in case.
Essentially, yes. Now, there might be limits. One source mentioned that a waiver signed specifically in connection with a filed installment agreement might extend the CSED by no more than 5 additional years. But the core point is, yes, you can agree in writing to give them more time.
Okay, so the takeaway here is that many actions you might take yourself, often positive steps trying to resolve your tax situation, like bankruptcy, OICs, installment requests, appeals, can inadvertently pause that 10-year clock and end up giving the IRS more time to collect than you might have originally thought.
It's absolutely crucial to understand that. Pursuing these resolution options is often the right move, definitely better than ignoring the debt. But you need to be aware that doing so usually impacts the collection timeline. It tolls the statute.
Let's switch back to the audit side just for a moment. We talked about exceptions that automatically extend the audit statute, but the IRS can also just ask you to agree to give them more time, right? Through signing something called a consent. Why would they do that, and what happens if they ask you?
Right. The IRS might request that you sign a consent form, usually it's Form 872, if they feel they need more time to properly complete an ongoing audit.
Why would they need more time?
It happens fairly often, especially in more complex audits. Maybe they're waiting for information from you or from a third party. Maybe the case involves complicated legal issues that take time to analyze, or perhaps the audit just got started late or stalled for some reason. If they don't get an extension before the original 3-year or maybe 6-year statute runs out, they might be forced to close the audit prematurely and issue a notice of deficiency based on the incomplete information they have, just to protect the government's ability to assess the tax.
So they ask for a consent to allow more time for a thorough, fair review.
That's the idea, yes. Consents are allowed by Congress specifically to give both sides more time to get the facts straight and hopefully reach the right conclusion.
Okay, so let's say I'm under audit, and the IRS revenue agent sends me a Form 872 asking me to sign it to extend the audit statute. What are my options? Do I have to sign it?
You definitely don't have to sign it, but you generally have 3 main options based on our sources. First, you can simply sign the consent as presented. This is often an unconditional consent. meaning it extends the statute deadline to a specific future date, maybe a year out, and it keeps the entire tax return for that year open for audit on any and all issues until that new date. There's also a less common type, Form 872A, which is an open-ended consent, often used in appeals cases, that extends the statute indefinitely until either side formally terminates it. But the fixed date, Form 872, is more common during the initial audit stage.
Okay, so option 1 is sign unconditionally, keeps everything open longer. What's option 2?
Option 2 is you can try to negotiate the terms of the consent. You don't necessarily have to accept exactly what they propose.
How can I negotiate?
Well, you could try to negotiate for a shorter extension period than they ask for. Maybe they ask for 12 months, you could propose 6 months, or perhaps more significantly, you could request a restricted consent.
A restricted consent? What is that?
A restricted consent limits the scope of the audit extension to only certain specific agreed-upon issues on your tax return. For example, you might agree to extend the statute only for the issue of, say, your claimed travel expenses or the tax treatment of a particular stock sale.
Ah, that sounds potentially very beneficial. It would mean the statute clock would expire on time for all the other items on my return, while the IRS only gets extra time to look at those specific restricted issues we agreed on.
Exactly. It can be a very advantageous move if you can get the IRS to agree to it. It provides finality for the rest of the return. However, getting a restricted consent isn't automatic. It requires mutual agreement, and importantly, it usually requires approval from IRS legal counsel. They typically only agree if the scope of the remaining audit issues is very clearly defined and they feel they can resolve those specific issues within the extended time frame.
Okay, so sign unconditionally or try to negotiate for a shorter time or a restricted scope. What's the third option?
The third option is you have the absolute right to refuse to sign the consent altogether. Just say no.
Just say no. Okay, what are the practical consequences if I refuse? Is there a penalty?
There's no direct penalty for refusing to sign. It's entirely your right. However, the sources generally suggest that refusing is often a mistake from a purely strategic standpoint.
Why a mistake?
Because if you refuse to grant them more time, the IRS agent is likely going to take immediate steps to protect the government's interest before the original statute expires. They won't just let it run out if they think you owe more tax.
What kind of steps?
For income taxes, estate taxes, or gift taxes, refusing consent usually means the agent will quickly prepare and issue a notice of deficiency, often called a 90-day letter.
The 90-day letter.
Right. This is a formal statutory notice that states the additional tax the IRS proposes you owe based on the information they have at that moment. It gives you 90 days, or 150 days if the notice is addressed to you outside the U.S., to do one of three things. Agree and pay the proposed amount, do nothing, in which case they'll assess the tax after 90 days, or, crucially, file a petition with the U.S. tax court to challenge the proposed deficiency before you have to pay it.
So refusing forces their hand and likely accelerates the process towards either agreeing, paying, or going to tax court.
Exactly. Compared to signing the consent, which might allow for more back and forth, more time to provide documents, and potentially resolve things at the agent level or with IRS appeals before any court is involved. For certain other types of taxes, like some employment taxes or excise taxes, if you refuse consent, they might just proceed to assess the tax directly without a 90-day letter. Your only recourse then would be to pay the tax first, then file a claim for refund, and if that's denied, you could sue for the refund in a U.S. District Court or the Court of Federal Claims.
So, the concern with refusing is that the agent, facing a tight deadline, might just make unfavorable assumptions against you or assess the maximum possible tax on any disputed items just to get the notice of deficiency at the door.
That's the risk, yes. They might not have time for a full, deliberative review of your latest documents or arguments. That's why most tax advisors generally recommend agreeing to a reasonable extension, perhaps trying to negotiate the time frame or restricting the scope if possible, just to allow enough time for the facts to be fully developed and hopefully reach a more accurate and potentially better resolution without immediately heading towards litigation.
That makes a lot of sense. Give them the time they need to hopefully get it right rather than forcing a potentially rushed and unfavorable decision. You mentioned different forms for these consents earlier.
Yes, just to recap. Form 872 is the standard one for a fixed date extension. Form 872A is the open-ended one, used more in appeals or specialized programs, that extends until one side formally terminates it. And Form SS10 is sometimes used for extending the statute for certain employment tax periods.
Got it. Now, what about something called a jeopardy assessment? Are those related to the statute running out or refusing consent? People sometimes worry about that.
That's a common misconception, but no, not directly. Jeopardy assessments are very rare and are used only in extreme circumstances where the IRS believes that actually collecting the tax would be endangered if they followed the normal assessment and collection procedures.
Like what kind of circumstances?
Like if they have credible evidence that the taxpayer is actively planning to flee the country, or is quickly hiding assets, selling off property to become judgment-proof, or their financial solvency is rapidly deteriorating, putting the tax collection at immediate risk.
So it's about imminent risk of non-collection.
Exactly. The sources are quite clear. Jeopardy assessments are not supposed to be made just because the regular statute of limitations is about to expire or just because a taxpayer refuses to sign a consent form. There has to be actual evidence of one of those other jeopardy conditions. These assessments bypass normal procedures and require high-level internal review and approval because they're so drastic.
Good to clarify that refusing consent doesn't automatically trigger something like that. One last point on extensions and delays. What about interest? Does interest stop piling up if the statute is extended by a consent or told by something like an OIC or bankruptcy?
Generally, no. The standard rule is that interest continues to accrue on any unpaid tax, penalties, and previously accrued interest until the entire balance is paid in full. This continues regardless of whether the statute was extended by consent or told because you filed for bankruptcy or submitted an OIC.
So the interest clock keeps ticking away.
It usually does. There are some very specific, quite complex exceptions where interest accrual might be temporarily suspended on certain individual income tax deficiencies if the IRS doesn't send you a notice within certain timeframes, like 18 or 36 months after you file. But those rules are intricate, and the interest often restarts later anyway. The most reliable way mentioned in the sources to stop interest from accruing on a disputed amount during an audit or appeal is to make a cash deposit with the IRS specifically allocated towards that potential deficiency.
Okay, pay now, argue later, stops the interest clock. Makes sense. We've navigated the standard rules, the many exceptions that extend audit and collection times, and how taxpayer actions or IRS requests impact these statutes. Now, let's briefly touch on a couple of special considerations, starting with payroll taxes for businesses.
Right. Payroll taxes are absolutely critical for any business with employees. While the audit assessment period generally follows similar rules we've discussed, like the 3-year baseline, the collection statute is very relevant here, as are the penalties, which can be particularly severe.
What's the collection rule for federal payroll taxes, like the Form 941 taxes?
It's generally the same as for income taxes. There's typically a 10-year collection, SOL, CSED, for assessed federal payroll tax liabilities, starting from the date the tax was assessed.
And can that 10-year period also be extended or tolled?
Yes, absolutely. It's subject to many of the same tolling events we discussed for income tax collections. If the business never filed the payroll tax returns, indefinite assessment collection. If the business files for bankruptcy, pauses plus 6 months added. If there's fraud involved, indefinite civil assessment collection, 6 years for criminal. If the business submits an OIC or requests an installment agreement, pauses during review. Or if the business signs a waiver agreeing to extend the CSED.
And you mentioned the penalties for payroll tax problems are particularly steep.
They absolutely can be, yes. They are a major reason why businesses need to be incredibly diligent with payroll taxes. You've got the standard failure to file penalty, up to 25% of the tax due, and the failure to pay penalty, up to 25%. But then there are penalties specific to payroll taxes.
Like what?
There's the failure to deposit penalty, which applies if you don't make your required payroll tax deposits on time and in the right way. This penalty can range from 2% up to 15% of the underdeposit, depending on how late you are. But the really big one, the one that keeps business owners up at night, is the trust fund recovery penalty, or TFRP.
Ah, the TFRP. That's the one where the owner or manager can become personally liable for the business's unpaid payroll taxes, right?
Exactly. This is a very powerful tool for the IRS. It applies specifically to the trust fund portion of payroll taxes. That's the income tax, Social Security tax, and Medicare tax that employers withhold from employees' paychecks. Employers are legally required to hold this money in trust for the government and pay it over.
It's technically the employee's money they're holding.
Precisely. So if the IRS determines that a responsible person, which can be a business owner, a corporate officer, a bookkeeper, basically anyone with significant control over the business's finances and payment decisions, willfully failed to collect, account for, or pay over these trust fund taxes, that individual can be held personally liable for up to 100% of the unpaid trust fund amount.
Personally liable. Even if the business itself is an LLC or a corporation, it pierces the corporate veil.
Yes. The TFRP attaches to the responsible individuals personally. It doesn't matter if the business entity collapses or goes bankrupt, the IRS can still come after the personal assets of those deemed responsible and willful.
That is a huge personal risk. So what are the key takeaways for businesses regarding payroll tax compliance and these statutes and penalties?
The core message from all the sources is really about diligence and promptness. First, file all your payroll tax returns, like Form 941, on time, every time. Second, make your required tax deposits accurately and on time. Third, maintain meticulous records, payroll registers, employee information, proof of deposits and payments. The IRS generally requires you keep payroll records for at least 4 years after the tax is due or paid, whichever is later. But given the 10-year collection statute and potential TFRP issues, keeping them even longer is often safer.
What else?
Ensure you're correctly classifying your workers. Are they truly independent contractors, or should they be employees subject to withholding? Misclassification is a huge red flag. Using a reliable payroll service or software can help minimize errors. Consulting regularly with a knowledgeable tax professional is also crucial. And finally, always respond promptly and completely to any notices you receive from the IRS regarding payroll taxes. Don't ignore them.
It sounds like preventing payroll tax problems in the first place is far, far easier and cheaper than trying to clean up a mess later, especially with the threat of personal liability and extended statutes.
Absolutely. An ounce of prevention is worth many pounds of cure when it comes to payroll taxes.
Okay, shifting focus again, we've talked a lot about federal IRS rules. What about state taxes? Do the states just follow the same federal statutes of limitations?
No, definitely not. And this is a really crucial point that trips up a lot of taxpayers and even some advisors. States have their own independent statutes of limitations for both auditing returns and collecting taxes. These state rules can, and often do, differ significantly from the federal rules. It's a very common mistake to just assume the state follows the IRS timeline.
Can you give us an example of how they might differ?
Sure. Our sources specifically mention California as an example. While the basic federal audit statute is generally 3 years, the California Franchise Tax Board, or FTB, typically has a basic 4-year audit statute for state income tax returns.
So right off the bat, California gets an extra year compared to the IRS for a standard audit.
Exactly. And that's just one state. Others will have their own variations.
Do states also have situations where their statute becomes indefinite, like the IRS does for unfiled returns or fraud?
Yes, many states follow similar principles there. The sources confirm that many states, including California again, also have no statute of limitations for assessing or collecting state taxes if you never file the required state return for a particular year, or if you file a state return that is false or fraudulent. So, just like with the feds, non-filing or fraud can leave you perpetually exposed at the state level for those years.
Okay, here's a key question. What's the connection between a federal audit and my state taxes? If the IRS audits me and changes my federal taxable income for a past year, how does that affect my state tax liability and, more importantly, the state's statute of limitations for that year?
This is a particularly tricky area, and it's where taxpayers can really get caught out if they're not careful. Many states, and California is used as the example again, have a specific requirement. If the IRS makes adjustments to your federal tax return that change your tax liability, you are required to proactively notify the state of those federal changes, usually by filing an amended state tax return within a specific time frame.
I have to tell the state myself about the federal changes.
Yes. You generally can't just wait for the state to find out from the IRS. For California, the source indicates this time frame to report federal changes is typically 6 months after the federal determination becomes final. For example, after you agree with the IRS agent or after a tax court decision is no longer appealable.
Okay, 6 months to file an amended state return after the federal audit is final. What happens if I don't do that? Maybe I just forget or I didn't realize I had to.
This is the critical point. If you fail to file that required amended state return reporting the federal changes within the state's specified time frame, like the 6 months in California, the state's statute of limitations for assessing additional state tax based on those federal changes may never run out.
Never. It stays open indefinitely just because I didn't file the amended state return.
That's the rule highlighted in the source material for states like California. Failing to make that timely notification essentially keeps the state's door open forever to come back and assess the additional state tax that results from the federal adjustment, even if the state's normal 4-year statute would have otherwise expired long ago.
Wow, that's incredible. So Even if I've completely settled up with the IRS for, say, a 2015 audit in the year 2020,
Yeah.
if I didn't file an amended California return back in 2020 within 6 months, California could theoretically come after me for the related state tax in 2030 just because I missed that administrative step.
That appears to be the consequence under that rule. It's a really powerful example of how state procedures interact with federal outcomes, and how simply failing to follow those state notification procedures can completely override the standard state statute of limitations.
The advice seems crystal clear then. If the IRS changes your federal return, you absolutely must find out what your state's requirement is for reporting those changes, usually filing an amended state return, and do it on time. Otherwise, you risk leaving that state tax year open indefinitely.
Precisely. And states can also ask you to sign agreements, consents to extend their own audit or collection statutes, similar to the IRS process we discussed.
This all just brings us back full circle to the absolute critical importance of good record keeping throughout this entire process. If the IRS or a state tax agency comes knocking years down the road, you're going to need documentation to back things up.
Absolutely fundamental. Meticulous, organized record keeping is the bedrock of tax compliance and your defense if you ever face an audit. You need records to prove your income, to substantiate every deduction and credit you claim, and, crucially for statute of limitations purposes, to prove when you filed your returns and what you filed.
We've touched on all these different timelines, 3 years, 4 years for some states, 6 years, 10 years, potentially indefinite. It seems confusing. How long should people actually keep their tax records and supporting documents?
It is confusing, which is why the recommendations often involve keeping things longer rather than shorter. The sources provide several guidelines, generally aligned with the various statutes and potential issues. First, the baseline. Keep most of your supporting documents, receipts, invoices, canceled checks, bank statements, mileage logs, etc., for at least 3 years from the date you filed the return, or the return's due date, whichever is later. This covers the standard IRS audit period.
Okay, 3 years minimum for the basics.
Second, consider keeping them for 6 years if you think there's any chance that the substantial underreporting rule might apply. That 25% plus omission of gross income, or the $5,000 plus foreign income omission. Also, the statute for claiming a refund is generally 3 years from filing or 2 years from payment, whichever is later. Keeping records for 6 years provides a buffer for potential refund claims or amended returns as well. Some sources even suggest 7 years for claiming losses from worthless securities or bad debts. So 6 or 7 years is often a safer bet than just 3.
Okay, 3 is minimum, 6 or 7 is safer for potential underreporting or refund issues. What about longer?
Some advisors recommend keeping records for 10 years just to align with the Federal Collection Statute, CSD. While the IRS usually has the burden of proving an assessment was made, having your own records from 10 years ago could potentially help if there's ever a dispute about an old tax debt resurfacing or whether the collection statute has truly expired.
So 3, 67, or maybe even 10 years for supporting documents, depending on your situation and risk tolerance. What about keeping things forever?
Yes, there are definitely some records you should plan to keep indefinitely, or essentially forever.
Like what?
First and foremost, keep copies of the tax returns themselves, your actual filed Form 1040s, state returns, and any major schedules permanently. Storage is cheap these days. There's no reason not to keep the returns forever.
Okay, keep the returns forever. What else?
You should also keep records related to the basis of property and investments indefinitely. Basis is generally what you paid for an asset, plus certain adjustments like improvement costs.
Why keep basis records forever?
Because you'll need them to calculate your taxable gain or loss when you eventually sell or dispose of that asset, which could be many, many years, even decades, after you acquired it or made improvements. The statute of limitations for the year you bought the asset or paid for the improvement is irrelevant. You need the proof of basis in the year you sell it.
Can you give an example?
Sure. Think about your home. You buy it in 2010. You do a major kitchen remodel in 2015 and put on a new roof in 2020. You finally sell the house in 2035. To correctly calculate your taxable gain, if any, on that sale in 2035, you'll need the records showing your original purchase price from 2010, plus the receipts proving the cost of that kitchen remodel from 2015 and the roof from 2020, because those improvements increase your basis and reduce your taxable gain. Those receipts from 15 or 20 years ago are suddenly critical.
That's a great point. Same would apply to stocks bought long ago or maybe business equipment. The records are tied to the life of the asset, not just the tax year the expense occurred.
Exactly. So purchase records for assets, improvement cost records, records of stock purchases, including reinvested dividends, which increase basis. Keep all that basis-related documentation for as long as you own the asset, plus several years after you dispose of it, just in case.
And one last crucial piece of record keeping for statute purposes, proving you actually filed the return to get that clock started in the first place.
Absolutely critical. As we discussed, the audit statute generally doesn't start until a return is considered filed. So you need rock-solid proof of when it was filed.
How do you prove that?
If you still file by paper, always use certified mail with return receipt requested, or a reputable private courier service like FedEx or UPS that provides tracking and delivery confirmation. Keep that certified mail receipt or the courier tracking confirmation stapled to your copy of the return. That's your proof of the mailing date, which is generally considered the filing date.
And for e-filing, which most people do now.
For e-filed returns, keep everything. Keep the electronic file, like the PDF of the return itself. Keep the confirmation or acknowledgement you received from your tax software provider showing the date and time it was transmitted. And most importantly, keep the official acknowledgement from the IRS or state confirming that they accepted the electronically filed return. That acceptance confirmation is your definitive proof of filing and the date it occurred. Print it out, save it digitally, back it up.
Solid advice. Proof of filing is key to starting the clock. Okay, this all naturally leads to the question, what makes the IRS decide to audit someone in the first place? How do they even pick which returns to examine out of the millions filed?
It's a mix of things. The IRS uses sophisticated computer algorithms and data analysis combined with human review to select returns for audit. They're essentially looking for returns that deviate significantly from expected norms or contain inconsistencies.
What are some of the most common red flags or triggers that might cause a return to get flagged for review?
Several common audit triggers pop up repeatedly in the source material. A big one is inconsistent reporting. For example, if the income reported to the IRS by your employer on a W-2 or by a client on a Form 1099 doesn't match the income you actually reported on your tax return. Their computers are very good at cross-matching those.
Okay, matching third-party reports is key. What else?
Claiming large or unusual deductions or credits relative to your income level or your profession can be a flag. Think exceptionally high business expenses for a small side hustle that reports very little income, or claiming charitable contributions that seem disproportionately large compared to your reported earnings.
Things that look out of whack.
Right. Reporting significant business losses, especially from Schedule C, sole proprietorship, or pass-through entities, can also attract attention, particularly if those losses continue year after year, or if it's an activity that might look more like a hobby than a business run for profit.
What about just earning a lot of money?
Yes, having high income statistically increases your audit odds. It's not necessarily a red flag in itself, but the IRS tends to focus more resources on high-income taxpayers, simply because the potential amount of tax recovery is higher if errors are found.
And based on our earlier discussion,
Exactly. Issues related to foreign accounts and income are a major area of focus. Failing to report foreign accounts, omitting foreign income, or especially failing to file those required foreign information forms like the FBAR 3520, 8938, or 5471 is a significant audit trigger these days.
Okay, so if you do get that dreaded audit notice in the mail, what's the best way to approach it, keeping in mind everything we've discussed about statutes, records, and potential issues?
The advice is pretty consistent and clear across the board. First, stay organized. Hopefully you've followed the record-keeping advice, so gather all your relevant documents for the year under audit. Have them readily available.
Second,
respond promptly to the IRS notice. Ignoring it is the worst thing you can do. It won't make the problem go away, and it can lead to the IRS making decisions based only on their information or escalating to collection actions. Acknowledge the notice, and if they ask for information, provide it or explain why you need more time.
And third,
seriously, consider seeking professional help right away, especially if the audit seems complex, involves large amounts of money, potential penalties, or any of those extended statute issues we talked about. A qualified CPA, an enrolled agent, EA, or a tax attorney who specializes in IRS representation can be invaluable.
How can they help?
They can communicate with the IRS directly on your behalf, which can reduce stress and prevent missteps. They understand the audit process, your rights, and the IRS's procedures. They can help you organize and present your documentation effectively. They can negotiate with the agent or appeal unfavorable findings. And importantly, they can analyze the statute of limitations issues to see if the IRS is even allowed to be auditing that year or assessing that tax in the first place.
Protect your rights and navigate the complexities. Makes sense. Okay, finally, let's say you do owe back taxes, and the statute of limitations for collection, the CSCD, has not expired, or maybe it's been extended or tolled in one of the many ways we discussed. You don't necessarily have to just sit there and wait for the 10 years to hopefully run out while interest and penalties pile up. There are proactive options to actually resolve the debt. Right?
Absolutely. Waiting and hoping the CSCD expires is generally a poor strategy, especially given how easily that clock can be paused or extended. Addressing the issue head-on is almost always better. The IRS actually offers several resolution options.
Like what?
Well, if you can't pay the full amount immediately, you can request an installment agreement to pay the debt off over time through manageable monthly payments. There are short-term plans, under 180 days, previously 120, and longer-term formal installment agreements. Another major option is the Offer in Compromise, OIC. This allows certain taxpayers who truly cannot afford to pay their full tax liability to resolve it with the IRS for a lower agreed-upon amount. The OIC process is complex, and acceptance depends heavily on your documented income, expenses, assets, and overall ability to pay.
Okay, payment plan or settlement offer. What if someone is in really dire financial straits?
If paying your taxes would cause severe economic hardship, meaning you couldn't afford basic living expenses you might qualify for, currently not collectible C&C status. This temporarily pauses active collection efforts by the IRS. They'll review your financial situation periodically, usually annually, to see if your ability to pay has improved. It's important to remember, though, that C&C status doesn't make the debt disappear. The tax is still owed, and interest and penalties generally continue to pile up while you're in C&C.
So it's temporary relief, not forgiveness. What about all the penalties that might have accumulated on top of the tax?
You can often request penalty abatement. This is asking the IRS to remove penalties that were added to your account. The most common reason penalties are abated is for reasonable cause.
Reasonable cause, like what?
Reasonable cause could be things outside your control that prevented you from filing or paying on time, such as a serious illness or hospitalization, a death in your immediate family, destruction of your home or records due to a natural disaster, or perhaps you relied on incorrect advice from an IRS employee, or even a competent tax professional, though that can be harder to prove. If you have a good compliance history, you might also qualify for first-time penalty abatement for certain failures to file, pay, or deposit.
So it's worth asking about penalty removal if you had a good reason for the original compliance issue.
Definitely worth exploring. And finally, there are numerous private tax relief services companies out there. These firms specialize in representing taxpayers before the IRS, helping with things like negotiating installment agreements or OICs, audit representation, getting levies released, and filing multiple years of back taxes. Of course, you need to choose these services carefully, as their fees and effectiveness can vary widely.
Lots of options to proactively deal with tax debt rather than just watching the calendar and hoping the statute expires.
Okay, we have covered a tremendous amount of ground today, really peeling back the layers on the IRS's statute of limitations. We started with those seemingly simple rules, 3 years to audit, 10 years to collect.
Right, the basics.
And then we dove into this, labyrinth of exceptions and extensions.
I think the key takeaway, the absolute core message, is that while the IRS does operate under time limits, typically that 3 years for audits and 10 years for collection, those periods are far, far from set in stone. They are not absolute and can be significantly altered by many factors. Yeah, it seems filing late, or worse, failing to file at all. Substantially underreporting your income, especially if it's foreign income, missing those critical foreign information reporting forms we highlighted, or, of course, engaging in outright fraud, all of those things can dramatically extend or even completely remove the standard time limits, potentially leaving those tax years open indefinitely.
And don't forget, your own actions, often taken with the best intentions to resolve things like filing for bankruptcy, requesting an OIC or an installment agreement, appealing a collection action, those can pause that 10-year collection clock, sometimes adding years to how long the IRS has to collect from you.
Which really brings us to a final thought, something for you, our listeners, to maybe mull over. If the IRS, under all these various exceptions and tolling rules we've discussed, can potentially go back many years, maybe even decades, to audit you or collect taxes, how prepared are you right now, today, to reconstruct and document your income, your expenses, your financial life from that long ago?
That's the million-dollar question, isn't it? Could you pull out the proof for something from 10, 15, 20 years ago if you had to?
Exactly. It really seems the most powerful tool you have isn't just hoping the clock runs out quietly without the IRS noticing. It's actively understanding the rules that govern those clocks, and then being absolutely meticulous, accurate, and proactive with your tax filings, with your record keeping, and with your responses if the IRS does contact you. Knowing just how far back they could theoretically go is really the essential first step in making sure they never have a reason to look that far back at your specific situation.
Stay informed, keep those records organized, especially the basis records and proof of filing, and please don't hesitate to seek qualified professional guidance when you're facing complex tax issues or dealing with IRS notices. It can make all the difference.
Sound advice. And that's a wrap on this deep dive into the IRS Statutes of Limitations. Thanks so much for joining us.
My pleasure. Until next time.